Okay, so we've got gradually people populating our participants area. Good afternoon, welcome to everybody. God, it was David Frost that used to say that once upon a time. And he's leading our Brexit negotiations now, or at least his namesake is. It's very nice of you all to join us. Thank you very much for coming along. This is our second webinar on the theme of Brexit Ends of Transition. The first webinar a couple of weeks ago was about export documentation that will be needed as of the 1st of January 2021. Today's webinar will be a bit more of a twist on the same theme, but something that's incredibly relevant for a lot of smaller companies, and that's the theory of e-commerce. With us today, we've got Phil Rees, who'll be talking about e-commerce and what's going to be changing, especially with the VAT and import duty charges that will be levied from the 1st of January, no matter what happens in the Brexit negotiations. Also with us today, we're proud to have Lance Hobbs from the HR company, Prashant Yadav from Oasis, Nauzar from Branduin, and Sally Smith quietly in the background supervising from our Chamber of Commerce, and we're all suitably managed by Lisa Rides in the background managing this webinar. Can I first of all very much welcome Phil Rees, who is going to talk to us now all about and present all about e-commerce in the EU from 2021. Phil, all yours.
Thank you, Alan. So I'm just going to share my screen so that you can see my slides. Bear with me a moment. Does that look good?
Yes, it does. Looks very good.
Excellent. Okay. So yes, thank you for the opportunity to present, Alan. This is a presentation that I gave to Department for International Trade webinar about 2 weeks ago on a very similar topic. Presentation focuses predominantly on business to consumer exports from the UK, or from GB, I should say, to the EU at the end of the transition. I work for a company based in Colnbrook called OCS Worldwide. OCS has been around for a long time. It began as an import facility for Japanese newspapers back in the sort of late 1950s. And the business has developed and changed and pivoted on several occasions, largely due to changing market conditions. But as we stand today, we handle import and export operations. We're what's called an authorized economic operator for UK customs. So we operate under what's called a memorandum of understanding. And we're also considered a fast parcel operator with a transit facility for goods that are under customs control that are not to be imported, but are just transiting through the UK. In the last 10 years, OCS's business has become largely driven by e-commerce. We deal with some very big brands right through to the sort of smallest of micro SMEs and startups. And we're also a member of the Association of International Courier and Express Service Providers. My background, I've been with OCS just coming up for 3 years, but been in the international mail and parcels arena for around 15 years. At OCS, I look after the sales team, marketing, customer service, logistics, IT, our pick and pack and fulfillment by Amazon business. So I've worked on lots of e-commerce export projects with lots of online retailers over the years, and you know, right the way through from the smallest guys up to the largest sort of online only pure play retailers. So by that I mean the likes of ASOS, Misguided, Boohoo, those sorts of fashion brands. So in terms of the end of the transition, ultimately for an e-commerce parcel exporter, there are 2 changes that come in on the 1st of January. One, obviously Brexit, we're all well aware of, but the other is kind of less prevalent or less high up in people's thinking. But where the post is used as a mechanism to export from January, and this has no relation to Brexit, it's just coincidental. But for all postal material, so small letters and packets that are moving through a postal channel, as of January, the shipper is required to provide a full and rich data set to accompany the shipment, even if it's being sent as untracked airmail. So what that means is that CN22 and 23 declarations will need to be applied to parcels, not just for rest of world, but also for Europe. But those CN22 and 23 declarations also need to be supported with an EDI file, an electronic data interchange file, which is ultimately a feed of information to your carrier detailing exactly what's in the parcel and some specifics around its contents. This change to the post has been coming since 2013. So Royal Mail have been issuing guidance on it for some time now. If you Google getting your data ready Royal Mail, you'll get to their help pages, which are very detailed and useful. But ultimately, the sort of negatives or the connotations of not supplying pre-advice data with your parcels is that they could be returned or destroyed, or face significant delays or additional handling charges. That only applies to goods, incidentally. I should have probably made that clear. Anything printed, so magazines, letters, documents, that sort of thing, the data advice isn't required. This is very much for things that have been sold and shipped as sold goods. So in terms of Brexit, what does it mean for e-commerce shippers? Well, you know, regardless of what happens over the course of the next couple of weeks, we will be leaving the single market and the customs union. So whilst a deal may present some potential easements for a lot of e-commerce sellers, really it's not going to make a great deal of difference. The reason I make that statement is that with trade deals, the way they work is that they are generally only the easements or kind of benefits that come with a trade deal generally only apply to goods that are manufactured within the territories of that trade deal. Now, what that means is that if you sell, for example, Scottish whiskey or British-made car parts, or you know, anything that's wholly manufactured within the United Kingdom or within Europe, then you may benefit from easements that are made within a trade deal. But in terms of our e-commerce customer base, there are really very few that can state that their goods are wholly manufactured within the UK or Europe. So, you know, for goods manufactured in Turkey or China or in the Middle East, or you know, anywhere outside of the European Union, then really a trade deal is going to do very little to help retailers that sell those types of goods. We know that we're going to require declarations, so the declarations themselves take a little time to complete, and there's an administrative process that goes with that. But really, the choice that a shipper, an e-commerce seller, needs to make in all of this is that where there are additional costs, do they want to bear the costs themselves as the shipper of the item, or do they wish that the buyer, the receiver, their customer has that financial cost to bear? And by the costs, what we mean specifically is a transaction fee, which is generally an administration fee, import VAT, import duty, and in some cases a deferment fee as well. So when using the post, what will ultimately happen is that post is shipped on a delivered at place Incoterm, DAP, or in old money it used to be called DDU. So if you transact through Royal Mail or through Ascendia or any of the various postal providers that operate out of the UK, using their traditional postal airmail systems, ultimately there's no choice. The goods any import VAT, import duty, or fees associated to the parcel will have to be borne by the recipient as opposed to the shipper. So I've added a few asterisks there. The deferment fee is ultimately a little bit of interest on the VAT and duty that companies like OCS and others will be paying at the border. So, you know, for every £100 of VAT, we're proposing, I think, to our customer base to charge a deferment fee of around about 1.5%. So £100 worth of fees paid by OCS at the border would mean a bill to the customer of £101.50. By additional logistics, what I mean there is that in order for once a customs border is a reality between the UK and Europe, ultimately there are two parts to the process of crossing that border. So you have your export side, which would be the UK side, and your import side, which would be the European side. Now, when organizations like OCS are modeling their flows of logistics into Europe, at the moment, we're able to go, you know, with volume permitting, obviously, but we're more or less able to go more or less directly from the UK to the receiving country, because there's no border to cross. Therefore, the truck doesn't need to divert or do any detours. When the customs border comes into play, our vehicles, our lorries, are going to have to transit through import customs gateways in order to then be cleared and into free circulation. So, for example, if you're traveling or if you're clearing customs in France, that might not be the natural route to you know, if you're traveling, for example, to Northern Europe. So there's potential for a bit of additional mileage, which will be in some cases reflected in the costs. So one of the things I took the DIT webinar through was some principles of customs, but you know, Alan sort of explained that most people on this call are probably reasonably familiar with customs processes, being as you know, you're all geographically so close to the airport. But just to skim through some of these things. So customs are governed by the World Customs Organization, the WTO, the World Trade Organization, and in the postal world, an organization called the UPU, which is the United Postal Union. And here in the UK, that governance is provided by HMRC and Border Force. I've already covered the second bullet, which is the two parts to the process, import and export. And the receiving country or trading bloc will typically define the taxation rules, thresholds, and any applicable tariffs, which we'll come on to in a minute. So the process is monitored by post offices, accredited carriers and agents, and customs brokers at the ports, whether those be road ports, seaports, or airports. And the process is eased and sometimes costs lowered when countries or trading blocs agree an FTA. But coming on to my earlier point, the FTA generally only benefits, or almost exclusively only benefits, goods that are manufactured within the geographical area of that FTA. So in terms of clearing customs, there are two mechanisms. So we have postal clearance, which is the mechanism that the likes of Royal Mail and their competitors would use. And then there's what we would consider commercial or express clearance, which is where an organization like OCS or somebody who's customs accredited can handle the customs formalities and discharge the required information. Postal clearance requires declarations CN22 and CN23, and as I mentioned earlier, it also now requires electronic data to be exchanged. And for commercial clearance, the normal paperwork that you would append to a shipment would be a commercial invoice. But again, best practice is becoming to supply that information on the commercial invoice electronically as well as just in hard copy format. And when no easements or free trade arrangements are in place, then two countries revert to WTO terms, which is a kind of umbrella set of trading terms that any country can use to any other country that they wish to trade with, which ultimately, if we don't end up with a deal, where we'll be, you know, where the rules will be set for how we transact with Europe. So in terms of principles of customs and what customs authorities are ultimately interested in, and this kind of comes into the whole declarations piece, what they're interested in is specifically what is being bought and sold. So what are the contents of the parcels? who sold those items, who bought them, how much they paid for them, and importantly, when you're considering duty and tax thresholds, you must also factor in the cost that you've charged the consumer for the shipping. So if you've sold a dress for £25 and you've charged a fiver to ship it, then the customs value of that shipment would be £30. Customs are also interested in what the goods are made of. So what's the material composition and where did they come from, i.e. the country of origin? Are there any specific licensing or excise controls on the goods, i.e. things like tobacco, alcohol, and firearms would all have additional licensing requirements. To come on to Alan's point, what about the VAT? Is it being accounted for? Who's fiscally responsible for it? Where is it going to be collected from? And where any import costs are incurred, who's going to ultimately pick up the bill for them? So going back to the point I made earlier, on a B2C parcel transaction, it's one of two choices. So a seller or shipper paid setup where duties, taxes and fees are recharged back to the person that sold the goods. So that's a DDP, delivery duty paid Incoterm. And then the converse of that, delivered at place or DDU, is lower cost for the shipper, but highly likely to increase the amount of returns and refunds that they have. What I mean by that is that if, for example, you've sold to a German consumer, let's say you've sold this green jacket for €100. On a €100 transaction, assuming 20% VAT, then obviously there's going to be €20 worth of VAT that would need to be paid. €100 isn't enough to tip it into import duty, so it would just be the VAT in this example. But the other thing to consider is that through a DDU process, the delivering post office in Germany would be Deutsche Post, and Deutsche Post will charge the consumer a fee for them transacting and collecting the duty or the VAT. So on that €100 jacket, you're looking at €20 worth of VAT, and then probably anything between 8 and 12 euros is about the norm for what's called the carding fee. And those carding fees will differ from one country to the next. So for ease of maths, let's say if the carding fee with Deutsche Post is £10, so you're going to have your €100 or 100, let's say euro, so I'm getting my currencies mixed up. €100 transaction, customers paid €100 at the checkout, then the parcel will find its way to Germany. Deutsche Post will get in touch. They'll say that item you bought for €100, we want €20 worth of VAT and also a carding fee of €10. So we want you to pay €30, and when you've paid that €30, we'll release the shipment for delivery to you. Now, clearly what's going to happen with many of these transactions at that point is the consumer is going to think, well, actually, I like that green jacket for €100, but I don't like it that much that I want to pay another 30 to get it delivered to me. So they can refuse the shipment, they can contact the retailer, demand a refund, and ultimately, I think a lot of low to medium value goods will end up bouncing back on a DAP or a DDU process. So worth, again, just reiterating the point, if you ship through Royal Mail, that is how it will work. It will be DAP, and if there's duty and tax to pay, your customer in Europe will have to pay that in order to get their shipment released to them. One other point worth noting is that if you sell through Amazon, whether you're selling on what's called the seller fulfilled setup or the fulfillment by Amazon setup, in either scenario, whether you're shipping the parcel or Amazon is shipping the parcel, Amazon have made it absolutely mandatory that the shipper picks up the duties and taxes bills. So if you try to ship on a DAP process, then ultimately what Amazon's guidance is saying is that they will monitor that through your seller scores and rankings and basically put your account on suspension if you're deemed to be creating friction for the Amazon consumer in Europe. So the all-important duty and VAT thresholds, so 0 to €22, and remember that's the cost of the goods plus the shipping and any insurance if insurance has been charged separately. So Once you add those three component parts together, so cost of goods, cost of shipping, cost of insurance, if you're 22 euros or under, then you don't really have too much to worry about. You can send those through the post, tracked or untracked, and they'll be delivered without any fees for you or for the consumer on the European side. If it's valued, or if the value concatenates to 22 to 150 euros, then ultimately what you're going to pay is border VAT at the domestic rate of the country where the parcel's crossed into Europe. So if they cross in Luxembourg, it'll be 17%. In France, I actually think it's 20%. I've got 21 there, but I think that's a typo. So yeah, 22 to 150 is VAT only. For anything 150 euros or more in terms of an e-commerce business to consumer transaction, then there will be duty to pay on that shipment as well. And for wearing apparel, which OCS is our largest kind of vertical in e-commerce terms, then the rates for duty are typically set between 10 and 12%. And it's worth pointing out that depending on the circumstances of the seller, some or all of these costs may be unrecoverable. The other thing to point out, which may or may not be on your radar, but I definitely recommend looking into, is the OSS or IOSS VAT scheme. The OSS part stands for
Okay, this is where Alan jumps in for a moment, as Phil seems to have frozen, and we'll let his signal come back to normality in a second. Hoping that there's not such a big distance between Colnbrook and Hounslow via a satellite hovering over the planet Earth at the moment. His okay, it looks like Phil's going to be completely lost for a moment, and I do believe Phil's back again. Hooray! Yes, and you're muted as well, Phil.
Did you lose me there?
We lost you on IOSS.
Ah, okay. Thank you. Not quite what happened.
I was paying attention.
Can you still see my screen?
No, we just got you. You need to share screen again.
Ah, okay. Apologies. Is that good?
Yep, perfect.
So yeah, so the OSS basically simplifies the whole European VAT situation. You make a single application, you get issued with an OSS VAT number, and you use that for each parcel to collect VAT at a single rate and remit it to a single European entity. So at the moment, the way VAT rules work in Europe is depending on how much trade you have with each member state. You know, you could in theory need 26 VAT numbers for the different European countries. So OSS just brings all of that into one pot and means that, you know, an online retailer or anybody that trades with the EU can do it in a much more simplified way. The one thing to note with OSS is that when that eventually comes in July, that first threshold of 0 to 22 euros will disappear and fall away. So VAT will be expected on every transaction from €1 upwards. This slide just goes into a little bit more detail in terms of what information needs to be transmitted to Royal Mail or other postal providers in order for your process to be deemed compliant from the 1st of January. So your CN22 and 23 declarations, which if you're shipping to rest of the world countries would be familiar to you, you'd be doing that already. But all of those, not just for Europe, but also for the rest of the world, must be accompanied with a compliant data file that can be transmitted to Royal Mail for each individual line of the parcel manifest. the postal EDI data, the most important parts of that are an 8-digit harmonization code or HS classification code. Those can be found on the HMRC website. So retailers need to classify their inventory with these codes. Country of origin details, where were the goods manufactured? Again, all of this hopefully will be already within the inventory, but if not, then it will need to be for the 1st of Jan. Full details of the sender and the receiver of the parcel, and detailed specifics of the commercial transaction. And then, yeah, just a reminder at the bottom there that from January, everything over €22 is going to potentially incur a carding fee and VAT from the consignee where it goes through the post. So I've put in some preparations, some things to check. First and foremost, I think this, as far as our education to our e-commerce retailers, the thing that we've been banging the drum about the most loudest has been the HS codes. For certain exports and certain destinations, we kind of need them already, but the combination of the Brexit change plus the postal data change means that now, if we don't have them from the 1st of January, it becomes extremely difficult to process parcels efficiently. There are ways that, carriers like OCS can look them up on behalf of the customer, but ultimately with anything to do with customs, the onus is on the shipper. So, the ideal solution is that shippers classify their entire inventory with 8-digit HS codes. If you study the trade tariff as well as the HS codes, that will also give you an understanding of the duty rates. Certain classifications of goods are exempt. I think baby clothes is one of them. So there are other exemptions. So it's well worth having a look at the trade tariff and working out what percentage rates are going to be applied to your inventory and whether there are any easements or exemptions that you can benefit from. And then the second point is about engaging with your carriers, your software partners, and anybody else that's involved in the process to make sure that you can kind of mitigate and defend against some of the inevitable increased costs. So check your carrier can support your preferred approach, i.e. you paying the additional costs or the consumer. If you have any third-party software systems that you use, like Shopify, Magento, Limworks, there are lots of them. Make sure that your carriers are receiving the information they need from those third-party systems, and consider, where needed, engaging new partners. One of the things that's become quite apparent to us recently is a lot of the European posts who have premises around the airport, because they've, for most part, never had to deal with customs processes before. In many cases, their kind of solutions for the 1st of January are quite limited and quite restricted. So, for example, if you intend to trade on a DDP basis, but at the moment you only transact with Royal Mail, then you need to be mindful of the fact you're going to need a new supplier. It's also worth taking advice from any VAT or tax specialists that you work with. When it comes to customs and goods and classification of goods and duty rates that apply and all of these kind of things, different retailers will have different requirements. It also depends on how much you sell to Europe. Do the distance selling rules need to come in, because you're selling X amount to a particular country. So, wherever possible, take specialist advice on the tax side of things. Hopefully everybody's registered for a GB prefixed EORI number. It's very easy to get one. The UK government actually pre-register all VAT numbers, so you can. There are some links at the end of this presentation, which I'll share afterwards, where you can check your EORI number, make sure it's valid, and if you haven't got one, make an application for one. Some customers may require an EU EORI number. There was a time where you could only have one, but you can now, I believe, hold an EU as well as a GB prefixed EORI number. So particularly for goods that are being imported in bulk into Europe, this is going to be important. And there's also fairly recently with the Northern Ireland Protocol been I think it's an XI prefixed EORI number for organisations that trade in and out of Northern Ireland. Research and take advice on your VAT position. Look into the import one-stop shop VAT regime. Work out what you're going to do, how you're going to approach VAT from the 1st of January till July when that comes in. And research the EU distance selling. So distance selling works a bit like VAT in the UK. So there's a threshold within each European country where if in revenue terms you sell that amount or more to that destination in an accounting year, then ultimately you have a requirement to register for VAT in that territory. So Germany, I think it's 100,000 euros. France, I think, is 35,000, and the thresholds vary along with the percentages of VAT that are applicable to each specific country. So worth looking into that as well if you've got significant existing trade with Europe. Review your sales channels, your selling prices, your shipping info, and your transit times. It's very difficult to predict exactly what the channel crossing is going to look like on the 1st of January. We're planning for some delays. The process that we're using ultimately means that our lorry will enter what's called a green lane because we'll have been pre-approved for departure before we leave. But with all the checks, balances, and contingency measures in place, I think it's still fair to assume that first week or even 2 weeks is going to be there's going to be some queuing and some delays, but hopefully it won't last much longer than that. But really, that's anybody's guess. If you sell through marketplaces, through your own website or anywhere at all, then make sure your listings, your shipping info, all of that stuff is updated. And yeah, there's plenty of help out there. So it's really just a case of knowing where to look, and these are some good places to start. So various links here along with my contact details, and obviously keen to help if anybody has any questions. That's me finished, Alan.
Fantastic. What a superb, detailed, excellent presentation. Thank you very, very much, Phil. DIT didn't oversell or undersell you. I hope that's Coca-Cola in that can, by the way. Okay. Next up, we have Lance Hobbs, who's going to talk to us about how you can employ people from the EU in the UK and how you can get work in the EU if you're a UK citizen as of the 1st of January. Lance, over to yourself. Thank you.
Thank you very much, Alan. Just a brief introduction to myself and HR department. As Alan said, my name is Lance Hobbs and I'm Director of HR department. And we work with local SMEs to help them prevent having people problems and look after their people throughout employment. I'm going to cover 4 main points today. First one is proof of right to work. Then I'll talk about employing foreign nationals after Brexit. I'll talk about working as a UK national abroad, because some of you may have people that do work abroad for your organisations. And then we'll talk about business travel in the EU. So straight into proof of right to work. So as an employer, you should already be checking and recording proof of right to work in the UK for all your employees and workers. And if you're not doing so, you need to catch up and check the passport or birth certificate of your employees. Current EU, EEA and Swiss nationals have the right to work, and anyone not from these areas should have a visa or a stamp in their passport giving the right to work. But as an employer, you need to check that. EU citizens will retain the right to work in the UK until 30th of June 2021, as long as they were in the UK before 31st of December 2020. So until that date, a valid passport, birth certificate or an ID card would be acceptable as proof of right to work. So the key thing really in terms of employing foreign nationals, if you haven't already communicated with your employees, now is the time to do it and don't delay. The transition period is now in place, as we all know, and that ends on 31st of December 2020. And EU nationals residing in the UK before 31st of December 2020 will be eligible for settled status when they've been resident for 5 years. And this will give them the right to live and work in the UK indefinitely. Those who do not have 5 years continuous residence can apply for pre-settled status, giving them the right to remain until they reach the 5-year mark, at which point they can apply then for settled status. Irish citizens, by the way, do not have to apply because there's a pre-existing agreement from prior to us being in the EU. EU nationals who are resident in the UK by 31st December 2020 have until 30th of June to make an application. Individuals must apply for settled status even if they have previously obtained evidence of permanent resident status. Citizens of other EEA countries, that's Iceland, Norway and Liechtenstein, and Swiss nationals can also apply under the settlement scheme. So when making an application, they'll need proof of their identity, their residence in the UK, unless they have a valid permanent resident document or a valid indefinite leave to remain in or enter the UK. You can give your national insurance number and allow an automated check of your residence based on tax and certain benefit records. And if that check is successful, you'll not need to provide any documents as proof of residence. The process of applying to the EU settlement scheme is different if you have a permanent residence document or indefinite leave to remain. So if you have a valid UK permanent residence document, to continue living in the UK after 30th of June 2021, you must apply to the EU settlement scheme, but you will not have to prove that you have 5 years continuous residence. Or you can apply for citizenship before the 30th of June next year as well. If you have indefinite leave to remain or to enter, you can continue to live in the UK without applying to the EU settlement scheme. However, if you choose to apply and meet all the other conditions, you'll get indefinite leave to remain under the settlement scheme, also known as settled status. And you'll not have to prove that you have 5 years continuous residence. You can view your status or prove it to someone else online, but you won't normally get a physical document. And that's quite important when making the checks later on. So employing foreign nationals from 1st of January 2021, free movement, as we know, is going to end. And the UK will introduce a points-based immigration system. Anyone you want to hire from outside the UK, excluding Irish citizens, as we mentioned, will need to apply for permission in advance. And it'll be under a points-based immigration system. Anyone coming to the UK for work must meet a specific set of requirements for which they're going to score points. And visas are then awarded to those who gain enough points. And I think the main way will be through the skilled worker route. And in order to get people in through the skilled worker route, from the 1st of January 2021, you'll need to have a sponsor license to hire most workers from outside of the UK. And under the new skilled worker system, anyone coming to the UK to work will need to demonstrate that they have a job offer from a Home Office licensed sponsor. The job offer is at the required skill level, which is effectively A level and equivalent, and that they speak English to the required standard. In addition to that, the job offer must meet the applicable minimum salary threshold, which is the higher of either general salary threshold at £25,600 or the specific salary requirement for their occupation known as the going rate. And I'm not going to go into the details of that because if you need to understand what that is, we'll look at that afterwards. We haven't really got time to go into the detail. And an applicant may still be eligible, by the way, if they have a job offer in a specific shortage occupation, and there'll be a list of those, a PhD relevant to the job, or a PhD in a STEM subject, that's science, technology, engineering, and maths, which is relevant to the job that they're applying for. There are different salary rules for workers in certain health or education jobs and for new entrants at the start of their careers. But further information on the going rate for those specific occupations, as I say, can be looked up. And people will need a total of 70 points to be able to apply and work in the UK. But there are other routes other than skilled worker, such as global talent, which is the top talented people across the world, graduate route for international students, and the intra-company transfers are just a couple of other examples that you can get people in. Becoming a sponsor does require an application, and existing sponsors will automatically be granted a new license with an expiry date consistent with their current license, and will receive an appropriate allocation of certificates of sponsorship. And the standard processing time for an application is usually about 8 weeks, but if there's a mad rush, of course, you can expect delays. You don't need to be a sponsor to recruit Irish citizens, as we've already mentioned, or anyone, of course, from the resident labour market with an existing right to work in the UK, which includes EU citizens with settled or pre-settled status and non-EU citizens with indefinite leave to remain. But you will have to pay for the licence, and it depends on which sort of licence that you're going to apply for, will depend on the cost. There's also an immigration skills charge, which is a fee paid by a UK employer for each skilled migrant worker they employ through the skilled worker and intercompany transfer routes. And that will be £1,000 from 1st of January per skilled worker for the first 12 months, with an additional £500 charge for each subsequent 6-month period. So it's important to know that these things are going to cost. So working as a UK national in the EU. If you've got employees that are living and working in the EU, you'll need to let them know that they will need to check what the rules are for their specific country. They may need to apply for residential status. There may be similar rules to the UK for applying to stay in the country they work in, but they should check what the rules are that apply to them based on the country that they live in. Their rights are guaranteed under the withdrawal agreement, and British citizens who are lawfully resident in EU member states before the 1st of Jan 2021 will be able to continue to live, work and travel. British citizens have until 30th of June 2021 to apply for resident status. So it's a bit like in the EU citizens in the UK. Although some member states have said that they will extend that deadline. It's the responsibility of each member state to set up a settlement scheme to register British residents. If somebody's in a profession, they will need to ensure that their current qualifications are recognised in the EU, else they might not be able to work in an official or professional capacity. And they should also check that any indemnity insurance covers the countries that they're working in. And the government has published advice for British citizens living in Europe, which covers making sure their passports remain valid, registering with the local authorities, exchanging their driving licence, and applying for a car insurance green card. And that leads me nicely on to business travel in the EU. So the EU has agreed to add the UK to the EU's list of visa exempt countries. And that means that British citizens have the right to travel to the EU after the transition period for up to 90 days without a visa within any 180-day period. And employers will need to support their employees in monitoring this and ensuring there are no compliance breaches. Employers also need to assess the activities that employees propose to conduct during those business trips, because you might well be going to Europe and you can go on holiday for that period of time. But if you're going on business, you also need to ensure that they fall within an exemption to the work permit rules of the host country, which can be complex. Each country will set their own rules. That means that activities may be permissible in one country, but not in another. And if no exemption applies, a work permit will be required, resulting in additional time and cost for employers. After the transition, EU border guards may ask people travelling from the UK for additional information, including the duration and the purpose of their stay. Passports must be valid for at least 6 months after the end of the trip. They'll also need a valid travel insurance, including health, and don't forget, because the EHIC will no longer be valid. And you may also be asked to prove you have enough money for the length of your stay, even if you're going on a business trip. And border queues, of course, may be longer as you can't use the EU lanes anymore. As with living in the EU, you'll need to ensure you have the correct driving licence, which may need to be an international permit, and that you have the correct insurance. Mobile phones may no longer have a guarantee in terms of roaming charges, although the big operators have said that they have no plans to change their policies. And you also need to be careful when taking goods to and from the EU, as we've already heard, as the amount you can take in or bring back may well change, and there may be charges. So if you're taking goods over to sell, then you need to be considerate of that. And finally, as a reminder, make sure you have the right checks in place to get everything ready. Start now, be careful to check what you need and when you need it to make sure that things are not held up for you, your employee, and your business. So make sure that your policies are also up to date. What I will be doing is sending this over to as a briefing sheet for everybody as well. So hopefully you haven't all been scribbling down the notes rapidly. And yes, and if there are any questions, of course, we'll answer them for you either at the end or offline as well. And that is my presentation. Thank you very much, Alan. Back to you.
Wonderful. Thank you very much, Lance. Everybody will be pleased to know this is being recorded and will be put up on our website for posterity. We're yet to see what's going to happen on the 1st of January, but all of what you've said is absolutely on the button for what we need to know today. And it looks like that's exactly what will be happening. So next up, we have the very learned Prashant from Oasis Accountants, the superb accountancy firm in Chiswick, who will be telling us all about the implications of tax that you need to know as of the 1st of January. Happy New Year to everybody from the EU.
Yeah, thank you. Thank you, Alan, for your kind introduction. Hi, everyone. Good afternoon, everyone. Just very briefly, I'll also introduce myself and our firm. We represent Oasis Accountants. We are accountants and financial advisors. We have an accountancy firm, a wealth management firm, and estate planning firm. So we do like a start to end accountancy services as well as advice, which is required for a client, right from the journey when he has started his business, when he has saved, and also his IHT planning. Most of the key points are covered by Neil and Lance. Just to re-emphasize a couple of points which they have mentioned is firstly the EORI number. It's very, very essential, very, very essential if you're a business and if you're planning to do a business with EU, you need to register your EORI number. It's like economic operator and registration number. Without this, you won't be able to do your paperwork. So if you have not applied for one, please do apply very quickly. Obviously, you really need to have a specialist on board because after BRIC exit, there are a lot of new regulations and new taxes and codes and other stuff. So you need to know your commodity codes when you're supplying goods or when you're exporting goods to the EU. So make sure you have your commodity goods, what you're buying and selling. Freight agent and your hauler, make sure you have given the information what it requires. Today we are talking about what we need to prepare as exporting businesses to EU, but also understand what supplies requirement are there. We as a EU, we as a British business, because there'll be a lot of requirement from suppliers in Germany. There'll be a requirement of supplies in France or anywhere in those EU countries. So get those requirements, what exactly they require for a business to provide in terms of paperwork, in terms of various information for a company related. Check the goods regulation, because obviously your goods must be as per the EU standards and how these goods are approved in the EU market. So obviously this regulations and this is going to increase as you have to deal with each and every country separately where you're exporting or importing. So check the standards. We have been already complying with the Information Commissioner data. So they'll be just make sure you're complying after BRIC exit in terms of the ICO data. Check what kind of data flows of information is going to and fro. Check the requirements with the supplier. Lance has already covered about EU settlement and sponsorship license and all. It's very essential that businesses apply for sponsorship license if they're looking to hire any employees from abroad, and these rules are getting relaxed. We have a lot of new changes from 1st of Jan. HSMP, which was there in early 2010, which was scrapped. So the HSMP is coming back again. And UK do require a lot of workforce, and the workforce which is going to contribute to the economy. So make sure you as a business are prepared, and there's a lot of resources available from the government in terms of different immigration, what you can apply. There is a sponsorship license. There is a sole representative visa available out there. So if you have a business anywhere in the world and you can have an office over there, that's one of the most easiest visa to apply, and easiest, you can get one of your representatives back home over here. Sponsorship visa and point-based system, tier-based, they're required to have a more compliance than the sole representative visa. Also, in terms of taxes and all, the EC sales list and all, it is going to be there in terms of filing with each and every EU country. But obviously, you have to be very careful in terms of filing the VAT returns, because at the moment, the B2B VAT is not charged. And as Neil explained, how the VAT is going to be charged in terms of different countries, in terms of what is going to be the import duty, and we as an accountant will be checking for our clients in terms of which country it's exactly imported the goods, where they have paid the VAT. So it's very, very important to get help of a specialist in terms of this, because some of the rules during the period of transition, it's going to take some time in terms of understanding, filing. So make sure you have a VAT specialist on board. Make sure you have a freight specialist on the board. Make sure you have an immigration specialist on the board. Take advices for them. There is a lot of free advices available. UK businesses, most of the UK businesses, government has sent letters regarding the preparation. They have to send the letters regarding the EORI number. They have sent letters regarding the EU transition. If you've not received letters, just check your registered address, because most of the letters have been sent. A very detailed explanation is given in those letters in terms of if you're a business importing the goods to EU, if you're a business in UK exporting the goods to EU, what you need to do in terms of immigration and taxes. UK is still very competitive in terms of corporation taxes. So, UK is going to be a destination for the businesses and continue to have businesses going forward. We do a lot of consultation. We have a lot of international experts what we work with. There'll be a lot of requirement of a business to set up international offices, maybe in Ireland, or maybe in Germany, or maybe in France. So we help our clients if it's a requirement, because some of the countries or some of the suppliers might have a requirement to do that. So if that's a requirement, you can get in touch with us and we can help you in terms of filing. So we as a business, we can help you in terms of the VAT regulations, in terms of filing. But as a business, you have to make sure you are prepared. There's not an option not to be prepared in terms of EORI number, in terms of your VAT, what declaration you need to do. Hopefully there'll be a deal. There's a lot of news happening that the deal is going to be there. It'll be much better if there's a deal, and there'll be much better process. But if it's not, then we are landing at a different world. But hopefully there'll be a deal. So a lot of guidance available out there, and use the specialist. And as a business, prepare as a lot is required out there. And it's going to be just like a COVID, we have a new normal world. It's going to be a new normal world once we start complying with each and every country in the EU. Thank you very much.
As Boris says, be prepared. Well said, Prashant. Thank you very much. Nauzar, over to yourself. You have a presentation, I believe, that you're going to share a screen with. Nauzar Manekshaw from Branduin, please. Thank you.
Thank you, Alan, and good afternoon, everybody. I'm just going to get my screen share going. All right, and let me get it on full screen mode. Okay, so I've got a few slides, a couple of slides on who we are. A lot of you are familiar with us. I've seen many familiar faces in the chat files and in the participant list. So, okay, so welcome to you all. We are essentially a group of business advisors. We work with local authorities, entrepreneur hubs, and regional enterprise. We help them to deliver their strategic objectives, and we help them to target local and to access local businesses by programming, by delivery, by essentially managing resources and in terms of the times, outcomes, and budgets. And we also do an impact assessment study at the end of every program, which helps us and helps the local authority to justify the expense as well. We deliver through a combination, through close relationships with Hounslow Chamber in this case, with other chambers as well, and through our members who are business advisors and specialists. And what we deliver are business sprints, specialist workshops, one-to-one in mentoring, etc. And we focus on innovation and on finance, on marketing, and helping businesses in this day and age to reboot, recover, and to grow. Our services are three. We've got three sort of revenue streams. We have a business recovery program called Goal Mapper, which we implemented in Hounslow a few months ago. Fit to bid, helping small businesses to repair their supply chains and get fit to bid, to win, to get a bid ready, and to enhance their bidding skills and to win a few more contracts. We implemented a pilot in Ealing, which we are rolling out across a few other boroughs in 2021. And a new program, for us, we are starting something using our experience, our gray hairs or no hair in a few cases, where we're launching a new project called the Branduin Business Academy. So watch, a lot more on this in 2021. Okay, so where are we in terms of, I've looked at all the fantastic, presentations, and this is just to add a bit more information and depth where we are now. So the next 3 slides is about the EU in a transition. The UK has signed trade agreements with approximately 55 countries. There are some big ones, there are many small ones, and I'll put that into context as well. The CARIFORUM is a trade bloc of 14 organizations, 14 nations. This is basically the Caribbean. Then you've got some big ones like Switzerland and South Korea, Israel, etc. And of course, a big one in Canada as well. There are also something called mutual recognition agreements. These are agreements with 3 big countries, Australia, New Zealand, and the US, which basically recognizes 3 areas. One is on trademarks and IP. Second is on markings on your products, mostly your physical ones, which includes things like barcodes, etc. And the third is validation and agreement to respect each other's processes to sign off even in any new medical formulations, any new products, new types of food, etc. So these 3 agreements in hand now, so hopefully we'll be able to get on with what we do. There are lots of free trade agreements in discussion for continuity of EU agreements. So we're trying to get across to the other countries in this list, which includes Singapore, which is a big one. I think the UK are fairly confident that we should be able to get the Singapore agreement before December. The other ones are in sort of a discussion. Again, this page itself brings the total lot close to around 70 or 80. Okay. Trade deals at pre-negotiation stage. So this might take a little longer. There are some very big organizations, or very big, nations here. It's got the GCC, which is the Gulf Cooperation. India itself, the 3rd or 4th largest economy now. Mercosur involves your Brazil, Argentina, your Paraguay, and Uruguay, and including Taiwan. We've got a huge portion of business, hopefully to conclude by the end of March. That's what I read on the government plans. Right, of course, you'll see that in red, the big one, the European Union, free trade deals being negotiated as we speak now. I think Alan has some inside information which he's going to share with us in a few minutes. But to put that into context, the big one, the EU one, which I've highlighted in red, to put that into context, you can see that we got to get this done either way, some way, either way, because the impact is immense. You can see that the exports are close to 300. I mean, it's basically close to 50% if you look at it in terms of both exports or imports. So this is imperative. Everybody's on the case. We hope we get some news, but Alan's got some information which I hope he will share with you. One thing which Prashant rightfully alluded to is that this is not a problem which is going away. This is on us. It's a few weeks away. Our lives will change in terms of business and personal as well, as explained by Lance. So which one are you? Is your glass half full or half empty? Are you going to take advantage of the ensuing chaos? Hopefully not. But where there is some chaos or some sort of disruption, there is opportunity as well. Are you going to be able to take advantage of that? That's the question. Which one are you, half full or half empty? As you can guess, I'm half full. Okay. One last slide here before I hand over to Alan is just yesterday, the UK Export Finance launched a new scheme. There is a URL there. If you type in UK Export Finance, it's a radical new scheme for export finance for small businesses. In the sense, it's not only caters for a stock of our assets, it also caters for cash flow to help you fulfill your export contracts, pay for cost, build inventory, and ease your constraints. And it's up to 25 million pounds, depending on your turnover, obviously, if you're a larger organization. And it gives you working in capital to help you to recover from COVID. It's in association with the top five, which are the HSBC, Lloyds, NatWest, Santander, and Barclays, and other banks and other institutions will be added on over the next few weeks. So if you're in the export business, we've all been hit by COVID. If you want to get back, there is specific support now for exporters, just announced yesterday. Okay, so there's hot off the press. So here we are on the last slide. We've done 2 sessions sponsored by Hounslow Council in association with us, with Branduin, and a great big thank you to Hounslow Chamber. This is today's, and what we're planning to do next Tuesday at the same time is a bit more information, and I'll hand over to Alan on this point. Alan, you there?
Here we go. Yes, I'm all here, I hope, anyway. Thank you very much for your presentation, Nauzar. To comment on a couple of things, you asked about UKEF. I actually know UKEF very, very well. I've been into their offices in Royal Horse Cards many times. This year, in fact, this week, they've been given a dramatic increase in their spending born out of profits that they've made themselves. So it's internally generated. That will allow them to employ an additional 100 finance managers that will be rolled out across the UK to help smaller companies primarily get their cash flow better arranged so that they can export more. Not just offer buyers overseas finance to buy goods, but to also help UK companies finance the purchase of raw materials they need to satisfy those export contracts. So I've got a few slides that I need to run through, and I'm going to run through them extremely quickly. While I'm doing that, can I call on Phil to answer a couple of questions that have been posted in the Q&A section from Gominda Dillon, please. And I'm going to, at this point, see if I can share my screen while I talk. And right, so a lot of people have seen, right, here we go. A lot of people have seen this girl constantly looking around the corner. The days are ticking down, currently 24 days to go. Brexit transition time is running out. This is some slides that I picked up from the IPO office, talking about major changes in IP and IPO that's yet to happen. Those changes are going to be in copyright, trademarks, unregistered designs, and exhaustion of IP rights that there are in Europe. The key thing that's going to happen, which is a major point, is that your UK attorneys will be unable to represent you for new applications in the EU. Going forward, you're going to have to find an EU IPO to be able to help you with that. But if you've got anything ongoing at the moment, that will sort itself out and roll through. Also, any new applications that you put in, you're going to have to satisfy the IPO office that you've got a UK address before they'll be able to process your applications. This is going to affect yourselves on trademarks. Comparable UK trademark and trade designs will be created at the end of the transition period, and those will be changed over into a new UK registered trademark. At the moment, this doesn't look like it's going to cost anybody anything, and it's going to be quietly rolled out with the IP office doing an awful lot of hard work. You will not have to file for a new application on any of this, and you won't have to pay an additional application fee. This is simply going to be rolled through by the IP office ourselves. Business organisations and individuals who've applied for European Union trademarks which aren't registered in the UK are going to have to go through UK application fees, and that will work its way through quite quickly. Sorry for running through this fast. We've run out of our 1 hour and we're into the red zone at the moment. For Brexit IP office requests, I've put up some links which will be live on our website for people to look at. The key things of the key areas are about designs, international trademarks, unregistered designs, patents, parallel trade between the UK and the EEA countries. That's the whole of the EU, Iceland, Liechtenstein, and Norway. And any actions for intellectual property right holders, copyright and geographic locations. There's more information that I've put on a link at the bottom of this page. This is where I've got all of my information from. And finally, on my page, this is going to be the quickest run through of a presentation I've ever seen on IP. There's a video that the IPO office have sent to me this afternoon. I asked them for a link, asked them for a presentation for 10 minutes. They've sent me a video for an hour. Unfortunately, if I played the video in fast, you wouldn't be able to understand it. So you've got me talking quickly instead. However, this is going to be up on our website. So if you have the time, inclination, and want to know a lot more about IP, this is the place you'll be able to go and visit and see it all. And here's my final slide, very similar to the one that Nauzar put up, about please register for our final Brexit End of Transition webinar, where we're going to be discussing Brexit supply chain issues, the impact on the US presidential election, and hopefully next week we'll actually have some news of where we stand with the EU negotiations. Nauzar mentioned that I've got some breaking news. I picked up that Michael Gove announced on the lunchtime news today that after his negotiations with the deputy head of the EU, they've reached agreement on wording for the Northern Ireland impact of us leaving the EU, which will result in the British government not needing to pass a law that was deemed to be a breach of international law for us to leave the EU. My best guess is that would have been a major stumbling block had Boris, and when Boris goes over to Brussels later this week. So having cleared that point up nice and neatly, this does leave Boris to go over there and actually conclude something of a deal. Let's see. I'm going to stop sharing my screen now and come back. If everybody would like to turn their screens on, we can open this up a bit more to a Q&A session. And one of the first questions I spotted coming through was from Gaz Dillon, that was I've pushed on conveniently to Phil Rees to have a thought about while I babble on about IP. Sorry, present accurately about IP. Phil, do you have any comments you'd like to make back to Gaz?
I think I answered Gaz through the Q&A sort of texting area, unless I've missed it.
Right, no, you have. I've just looked. This is multitasking, you see, talking, doing presentations, and checking Q&A answers.
Yeah, I can't actually see Gaz's question now, but there's been a few come through.
He was asking about third-party logistics based in Europe, if it's more convenient to use them or to use a very good company in Colebrook.
Yeah, so I mean, you know, that's a natural question to be asking at this point in time. You know, should I move my stock to Europe? We've seen a bit of a mixed bag in that. Some retailers have, you know, moved to 3PLs on the other side of the channel and vice versa. I mean, one of the big female clothing brands has shipped from Germany for many years, Zara, and they've recently set up a big warehouse in Milton Keynes. So it's a difficult question to give a black and white answer to, because it does vary on, you know, what you're selling, how you're selling it. You know, are you using Amazon to drive sales? Are you driving sales from your own website? So it's probably one for me and Gaz to have a conversation with offline. I think, you know, whilst there are going to be transaction fees and, you know, a bit of VAT to account for and that kind of thing, if the majority of Gaz's products in terms of the price, you know, of the parcels themselves is under 150 euros, therefore not going to attract any duty, I would probably argue that it probably makes more sense to keep his stock in the UK, because through the one-stop shop regime, he's going to be collecting the right amount of VAT at the checkout, remitting that VAT in a compliant way in July through the OSS scheme, so not attracting any border VAT. So really the only additional cost for him when you net away that VAT is going to be duty, and if most of what he sells is under 150 euros, then there won't be much impact there either. So it does very much depend on the individual specifics, but yeah, hopefully that gives you a bit of a steer anyway.
Okay, superb, thank you. And Lance, a question from myself to you. Is this the much flaunted points system that the UK VI are going to be implementing on the 1st of January that you mentioned?
Yes, absolutely. Yeah. New point system comes in, various things that you have to comply with to get your points. And if you reach the threshold of 70, you're likely to be able to come and work here.
Right, and the better your qualification, the faster up that chain you're going to get very quickly, I would imagine.
It's certainly possible. I mean, it's if you reach the threshold, if you get the points, then qualifications are part of that. But there are other things as well that you have to factor in when you're looking at the point scoring system.
And if you're an EU national already living over here,
yeah,
are you just allowed to carry on, or do you have to pre-register to stay here? What do you need to do?
As I mentioned before, that if you've got up 5 years residency, you still need to apply for that settled status. But if you can prove that residency, then you'll have an automatic settled status. If you don't have the 5 years, you might well get pre-settled status. And then when it comes to the 5 years living here, then you can apply then for settled status. You have to have been living in the UK before 31st of December 2020. So in order to apply, but you've got until the 30th of June 2021 to make your application anyway. But my advice is get it in as soon as you can.
Okay. So, Phil, you have a question in from Vikram Singh, which I'll read to you. In light of the points raised by the gentleman from OCS, please explain why a UK exporter would now have to bear the additional cost of hiring specialist services, VAT, etc., when medium to long term, it would be best to relocate to Ireland or Germany.
I look like I've frozen on my own screen, but I'm assuming you can hear me okay.
We can hear you fine, yes.
Yeah, so the point about tax advice from my presentation was more around, just making sure that your approach to the well, particularly to the VAT is compliant with, the current regulations. Distance selling for VAT has been around for a long time. So, there is an obligation on anybody that trades with European countries to register for VAT in those countries when they meet the distance selling threshold. And depending on, what infrastructure the UK company might have, that might also influence how they want to transact in a post-transition environment as well. So, for example, one of our largest fashion brands have a European entity. So the way they're handling their customs process is very specific, but they've paid customs in the Netherlands a large easement, a large deferment. So they've basically placed money on bond with the Netherlands customs authorities. That's given them an easement that basically means that we clear their parcels in Amsterdam at Schiphol Airport, and then any import duty and tax is suspended for them for 30 days to allow, because they're a fashion brand, they have a lot of European returns. So what happens, any goods that get returned within that 30-day window get netted off the totals, so their import tax and duty is calculated on what sticks as opposed to what ships and comes back. So yeah, it was just really to make the point that everybody's situation will vary to some degree, depending on what you sell, where it's manufactured, how you sell it, whether it's direct through marketplaces, these sorts of things. It's just, I think, a good time to go and talk to your tax advisors or your accountants and just make sure that your understanding is correct and that your approach is sound.
And on that note, slipping neatly over to Prashant, our expert.
Yes. Yeah, I just wanted to make one point. I think there'll be some readjustments for the businesses to do. Sorry, guys.
Okay, you're back.
Can you hear me?
We can hear you fine, Prashant. Yes.
Yes. With this import duties and all, I think business has to make sure they have readjusted their cost, because obviously they can't. They have to maybe increase their prices, what they're selling locally, and it's very important to get those sorted out correctly, because obviously there'll be maybe a short-term inflation till other agreements are sorted out, because obviously UK will be really. The government will be in a very fast mode in terms of making the agreements. As of now, I think Japan is the only country where UK has signed the agreement and principally agreed with Canada. But most of the other countries, which was just explained in the presentation, that is in the way, be happening soon. But obviously, accountants will be having a lot of work in terms of taxation and declarations. So make sure you have a right advisor and a right tax consultant to make your VAT declaration correctly. Readjusting your cost as you're likely to pay maybe a little bit higher, even you're exempted for some time, you're likely to pay some higher cost, but make sure your costs are readjusted what you're selling to your clients locally.
Okay, very, very good. Thank you.
Yeah, thank you.
Japan, of course, is the third largest economy in the world after the US and China.
Yes.
The EU isn't yet a country. If it were, it would be above China, Japan.
Yes, absolutely.
So we've got one last question in the group, and that's from Manekshaw, who asks, how is the VAT charging with regards to service sales to the EU? And I'm going to add a little bit of a complicated question on top of that, because sometimes my life gets a little complicated. And this is a question, I guess, to Prashant and to Phil. You're off the hook, Lance and Nauzar. Congratulations. If you're delivering a service to a company, and 50% of the UK's exports are services now, and you're a UK company and you charge that service to a company in the EU, let's say France, but your delivery of that training service is carried out outside the EU. So you travel to somewhere in Africa to deliver that training service. You then come back having completed it, you send your invoice off to France. Do you charge them VAT or not, because the service has been delivered outside the EU?
I'll go first on that one if you like. I'm a logistics guy. We don't move services over borders, so I'm going to duck away and allow Prashant to answer it on my behalf.
You're on mute, Prashant.
If you have delivered the service outside EU, and obviously VAT is not required to be charged on that. There's no VAT required to charge outside EU. Okay, for the services that are offered for the services in Africa or America or anywhere part in the world, in Japan, you don't require to charge VAT as long as that service is delivered outside.
Right. So in terms of physically supplying goods, your proof of delivery of those goods is your bill of lading, your air freight document, your airway bill. You've got a document for it. When you perform your service, you don't necessarily have a document. Are you saying it's a good bit of advice to say, here's my training certificate, both sides sign it, yes, I've delivered my training and it's been done in this overseas country, and then that forms some sort of proof of delivery?
Yes.
Okay, excellent.
Yes, thank you.
All right, so we've got a last question then I'm going to throw in from Vikram Singh to Phil, and he asks, can the OCS gentleman, congratulations, he's still calling you a gentleman, explain how RoRo will get affected post 1st of January?
So RoRo is, or roll on, roll off is how trucks will be required to pass through the customs process. So ultimately, what the way it works is that there will be specific designated areas where customs will want to undertake any physical inspections and checks. So these are the RoRo ports, and depending on the trucking provider and how they've done their declarations and their safety and security checks and all of these kind of things. I mean, we're for our own purposes at the moment modeling what's called full trailer load options for Europe only. At the moment, we use a lot of groupage transport, And what a groupage transport setup means is that, you know, we might, for example, have a pallet for Spain, a pallet for Portugal, and a pallet for Italy leaving on the same truck. But that, you know, will hub somewhere in the European Union, and then, you know, through a distribution network, find its way to the receiving country. And on those groupage transport arrangements, what happens is your material, if you've got 3 pallets on a you know, an articulated lorry that carries 20 odd, you know, it's going to be other customers' material on that lorry with yours. So where the risk comes into that is that, you know, we can do all of our checks and all of our export procedures and get all of our permissions through from, you know, from the customs system before we set off. But if our pallets get placed on the back of a truck with, you know, somebody else's pallets from down the road who hasn't done their due diligence, maybe hasn't, you know, put their declarations in properly, or whatever the case may be, then our material is going to be held with theirs. So the row thing is, you know, for compliant trucking companies to enable their freight to be checked by customs in an efficient and quick way. Yeah, I'm not sure if that answers the question, but that's basically what it's about.
Okay, superb. So the time's half past. All I can do is to say thank you all very, very much. Thanks to our sponsors, Branduin and Hounslow Council. Thank you very much for Prashant. To our key speaker, Phil from OCS, to Lance Hobbs from the HR company, and Sally Smith's going to say a few words at the very end as she's turned the camera on. Or maybe she's not, she's going to smile. Okay, thank you all very, very much for joining us, everybody. Thanks again, Sally.
Thank you. Thank you all.
I'm sorry, I've said my bit.
All right. Thank you all very much.
It was very,
Good
very
to you all
interesting.
this afternoon.
Thank you. Bye. Bye.
Thank you.
Bye.
Thank you all.
Bye-bye.
Thank you. Bye-bye.